Hello, 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 and welcome back to another episode of Freedom Ain't Free. Today's video is about how did my 401k lose 25% overnight? In this video, we're going to talk about it. We're going to talk about all of the pieces of the puzzle that go in to qualified plans and how taxes take a big chunk out of your overall investment strategy. Welcome to the Freedom Ain't Free channel here. The purpose of this channel is to give you the wisdom, the knowledge, and the understanding of all the financial tools that are available to you in the economic space in order for you to get to what we like to call a state of financial freedom. How do we define financial freedom? We define it at between $120,000 and $160,000 a year in income coming in from your assets that you don't have to work for. And in America, if you're in that state, you are financially free. And so we want to give you the strategies that go along with how do you accomplish that. And we're going to be spending our time going through the individual pieces of the puzzle that all come together to connect that. So stay tuned. You don't want to miss. At the end of the video, we're going to be covering the solutions to this problem of how my 401k lost 25% overnight. My name is Joel Huey. I'm the principal at ARC Financial Strategies, where predicting the rain doesn't count, building the ARC does. We work with a group of people we like to refer to as Henrys. High earners, not rich yet. And our goal and our objective for our clients at ARC is to help them to get financially free. First thing we do for our clients is we help them to get what we refer to as their freedom number. That's the amount of money that you need to save and the return that you need to get in order for you to develop and build that $2 million portfolio for yourself. And then we'll offer you and give you the step-by-step instructions on how to accomplish that. If you wanted to book a session, there'll be a link in the comment section where you can book a session with me, one of the members of my team, and we'll get you your freedom number, no cost to you at all. Here on the channel, we're going to dig into this idea or this concepts of all of the things that go along with getting you to freedom. So hopefully you paid attention. So with at the ARC, we have a 7-step program, a 7-step system that's going to get you to financial freedom, and we want to take you through each and every piece of the puzzle and every step. Today's episode, we're going to be talking about taxes and how taxes can derail your overall qualified plan strategy and some solutions to that. But before we do that, I got a business proposal for you. So we're going to go into business together, right? And here's my proposal to you. Number one, I'm going to ask you to front all the money in our new business venture. I'm not going to put one dime of my money into our new agreement. Number two, I'm going to ask you to take on all the risk, right? So if we lose money in this strategy, I'm not going to lose any money. You're going to lose all the money. Number three, I'm going to ask you to manage the business on a day-to-day basis, right? You're responsible for opening the business, closing the business, managing all of the employees, all of the day-to-day operations I'm going to need you to do. And then 30 years from now, I'm going to come back and tell you how much you owe me, right? What percentage of the company, the percentage of the profits that you owe me. Who's signing up to go into business with me? I know the answer to the question is none of you, right? But did you know that this was the agreement that you made with the government when you signed up for your qualified plan strategy mostly through your employers, although individual retirement accounts fall into this category as well. So if you have a 401k, a 403b, a TSP, any qualified plan strategy, all of the money that's in that strategy is yours. Even if your company gave you a match, they already gave it to you. Therefore, that's your money in that strategy. Number two, you have to take on all the risks, right? If the investments you chose in your strategy lose money, the government's not coming in to make you whole. You're losing that money. That's money you lost. Number three, you got to pick all of the stocks, the bonds, the mutual funds. You've got to manage that portfolio. You got to decide when to sell it, when to buy. You got to decide whether you're holding on to the dividends. You got to make all of the decisions within that qualified plan strategy. And then 30 years from now, when you get ready to retire, the government's going to tell you how much of your portfolio you have to turn over to them. So we want to talk about taxes. We want to talk about where taxes are. We want to talk about where we think taxes are going so that we can understand how to maximize our qualified plan strategies and get what we need to get out of it that's leading us towards that $1.5 million to $2 million portfolio that we need. So when you look at taxes in our country, and I'm going to do a whole video specifically on the big, beautiful plan, but currently our tax code in America is set up by bracket, okay, by bracket. So I'm only going to talk about a married couple filing together in this conversation, just to keep it simple. But if you're single, if you're married filing separately, then your brackets are a little different than the ones that we're going to talk about. So if you're married filing jointly, if you earn between $0 and $23,850, you pay no taxes, right? So 0% tax from 0 to $23,849. Once you made $23,851, you move up in bracket, right? So your marginal bracket kicks in. The first bracket's at 10% bracket. Now, the reason why you wouldn't pay any taxes in that first bracket, it would really be 0, is because of the deduction that you will receive. Your standard deduction is basically going to wipe out the first $23,000 that you earn. So basically, you're not going to pay any taxes there. Once you get above that, you're going to pay a 10% tax on every dollar above that until you get to $23,851. Then you're going to go to the next bracket, which is the 12% bracket. And remember, we're talking about household income, right? So not just talking about an individual here, I'm talking about a household. So then the next bracket kick up takes you from 12% to 22%. So once you made $96,951, remember, as a couple, you're now in the 22% tax bracket. The next tax bracket goes to $206,701. You move up to the 24% bracket. Once you hit $394,601, you move up to the 32% bracket. And once you made $501,051, you move up to the 35% tax bracket. And the highest tax bracket we currently have in the United States of America at the federal level is 37%. And if you're making more than $751,600, you're going to pay 37% of your income in federal taxes. Now, what we have to understand is if we're planning on withdrawing from our investment portfolio somewhere between $120,000 and $160,000 a year, that's going to put us square into the 22% federal tax bracket from an income tax perspective. Right now, that's contingent upon them not changing the brackets. Now, they've said that we're going to have these brackets for some time, and we'll talk about that in another video. But let's just say that's true and we stay within that range. Well, if you got $160,000 coming from your investment strategies and you have Social Security coming in or any other income coming in, you're probably going to push over that $206,700 bracket, and then now you're going to go from that 22% bracket up to the 24% bracket. And what you've got to understand about the income that you're going to be generating from your qualified money is going to be considered ordinary income. It's not capital gains income. It's considered ordinary income. So you got to look at your 401k statement and automatically take 24% off of that strategy right off the bat, because you're going to probably be paying at a bare bones minimum that in federal taxes. And I'm not even including state taxes in our conversation. So, the idea or the concept that I've got X amount of dollars sitting in my 401k today, that's not a real number. You got to take off the tax bill from that, and then that's really what you have sitting in your 401k. Now, yes, your balance is your balance, and yes, your money is growing, but when you're thinking about freedom, when you're thinking about strategizing to get to that $2 million, you got to take the tax bill off of that, and then you got to get more gains within that strategy and within that program to make up the loss that you're going to take simply from the tax haircut that we know is coming. So when you get ready to remove money from your 401k, if you're under the age of 59 and a half, you're not only going to have to pay taxes, but you're going to get penalized 10% for that withdrawal. If you're over the age of 59 and a half, then you're just paying the state and federal taxes. There's no 10% withdrawal. So understanding that if I want to net out 120 or 160, I've actually got to remove from my portfolio a higher percentage or a higher number than that, right? So you got to factor that into your math. So at ARC, we do the math for our clients, and we let you know exactly what you need to save on a monthly basis, taking out the 25% minimum that we know we're going to have to pay in taxes coming from our qualified plans. And so when you pull all of those pieces of the puzzle together and we take the brackets into consideration, right, we got to factor in the cost that taxes come into our overall strategy. So we help our clients to understand that you are asking a lot from your qualified plans. You're asking your qualified plans to outperform the market, right? So the market goes up and the market goes down, and you want your portfolio to perform in the plus. The second thing you need your portfolio to do is outperform inflation. So if inflation rates are rising, right, then your portfolio has got to do better than the inflation rate for you to even be even in your purchasing power. And then lastly, you need your portfolio to outperform taxes, right? And the more money you make in America, we have a progressive tax code, the more money you're going to pay in taxes. And so if you throw all three of those things into the mix, if you're getting a return, you know, of 5 or 6 or 7%, even 8% for some of you all, that's not a great enough return to outdo those three evils that are attacking your qualified plan strategy. So we need to tweak your strategy and push it higher. You're going to probably have to take on a little bit more risk in order to accomplish what it is you set out to accomplish, or you're going to need to investigate tax-free options that will eliminate your 25% loss altogether from within your portfolio. So stay tuned, keep on watching, because we're going to be talking about the 3 tax-free options that you have available to you that you can use to do that. But before I give you those, I just want to go over once again the tax brackets. Start at 10%, go all the way up to 37%. What we have is a progressive tax code. So as your income grows from one level to the next level, your marginal tax rate increases, right? But your effective tax rate is based upon the splits within the bracket. So you got to calculate based upon the first $20,000, I paid the 10%. Then I paid the 12%. Then I jumped up to 22%. Then I jumped up to 24%. Well, that average is what's referred to as your effective tax rate. That's really what you're paying on a dollar for dollar basis, and you need to get with your tax professional or reach out to us here at ARC, and we'll get you your effective tax rate that applies to you as an individual. Once you have your freedom number, once you have your effective tax rate, now you know how to go about maximizing your qualified plan investment strategies, how much risk you should be taking on, and then ultimately what percentage of your investments should be in this qualified plan strategy. So now, here are your 3 options that are available to you in the tax-free space that you can utilize to get that 25% off your back altogether. So some employers will have a Roth 401k option. Roth is simply the senator who got the tax-free version of qualified plans or IRAs, individual retirement accounts, approved through Congress. He just wrote his name in the legislation. And so the Roth 401k allows you to invest money after tax. So you pay taxes on the dollar amount first, then you put it into your 401k, and you never had to pay taxes on the gains ever, no matter how much we gain in that strategy. So for those of you who have that strategy available to you, you want to move from the qualified strategy over to the tax-free strategy. In my opinion, if you want to take out this 25% tax bill that you have to pay. You can also have a Roth IRA, which is an individual retirement account. If you're under the age of 50, you can put in $7,000. If you're over the age of 50, you can put in $8,000. So if you want to stay within your qualified plan strategy up to the match to get the maximum amount of free money from your employer Every dollar above that, you could then move and put into a tax-free strategy like a Roth IRA, up to the limit based upon your age. And now you've taken at least a portion of your tax bill and paid it today, and then now your money is growing completely tax-free. You can also invest in municipal bonds or treasury notes, which are loans to the government. You loan the government money, the government pays you back. You don't pay either federal tax or state tax, depending on which of the strategies you use. Now, these strategies are great for tax purposes, but they're not very good at accumulating, right? The rate of returns on your bonds are relatively low in comparison to your stocks and mutual funds. But this is just a portion of your portfolio. So what we teach at our financial strategies is that no one strategy is going to get you there. We're going to need to utilize all of the strategies in order to get us a solid, well-diversified portfolio. So this is a place for your no risk but tax-free, or low risk but tax-free strategies. And the last option that you have is to utilize cash value that builds up inside of a life insurance policy strategy. A life insurance policy is not an investment, right? It is an insurance policy. But inside of it, there are features that will allow you to grow money. A traditional whole life policy, the insurance company is going to pay you a guaranteed rate of return, plus they're going to give you a dividend, a percentage of their profits every year. You can withdraw money from that policy through withdrawals or loans and never pay any taxes on those gains. You can also have an index universal life policy, which will take your cash value, link it to an index strategy, and then the insurance company will allow you to participate in their profits and their gains based upon how well they've done investing their overall portfolio. They'll give you a percentage of that back, which is basically referred to as your participation rate. Your money is not in the market, therefore you can't lose any money, which is why it's not an investment. If you're not taking on any risk, it's not considered an investment. So in this case, you're just getting the gains. You're not taking on any losses. The insurance company is taking on all the risk. You can also have a variable universal life policy, which will allow you to purchase pieces of, I'll refer to it as, mutual funds. You're not actually buying the funds, you're buying parts of a fund, but that money is you taking on some risk. Your money is going into an investment where you can take on some risk, but it also gives you an opportunity for gains. And you can utilize those gains by either withdrawing or taking a loan against the policy, and now you have that money coming out completely tax-free. So those are your three tax-free options that are available to you. Like I said, we believe that you need to utilize every single solitary tool that is available within our space in order for you to get your portfolio to that $2 million range. Once we get the $2 million built into your portfolio, then we can look at different strategies, and we're going to do a whole video on step 7 in our process, which is how to get financially free and the tools that you would use to maintain that wealth and pass that wealth on to the next generation. So thank you so much for joining us today. Again, we talked about how did my 401k lose 25% overnight, and the answer to that question is taxes. And you have to have a strategy in order for you to reduce your taxes and get the most gains as you can. Thank you for joining us. Make sure that you check out links inside of the video if you want to schedule an opportunity to sit down with me or one of my team, where we're going to give you your freedom number. We're going to do that for you completely free of charge. Also, we're going to put some links in there to some books that we encourage you to take a look at and read. These are great tools to help you with your mindset so that you can get financially free. Thank you for joining us for this episode, and we'll see you next week.